exciting things that come out of the new tax reform legislation have been the changes in the business income taxation provisions. Interestingly enough, these are permanent changes to the code, and we saw a substantial reduction in tax rates for C corporations and the creation of a completely new qualified business income deduction that's going to allow a lot of pass-through entities to reduce their overall tax cost on taxable income. Don, what do you think this is going to mean for our business owners, and what are some of the things they should be thinking about?
Yeah, James, I think that's absolutely right. A lot of our business owners are seeing these drops in rates and thinking to themselves, it might be a good opportunity now to potentially switch entity types. You're seeing C Corp maximum marginal rates dropping from 35% all the way down to 21%, a difference of 14% there, while the individual highest marginal income tax rate is only dropping 2.6% from 39.6% to 37%. Now, where the individual rate might get skewed a little bit is, like you mentioned, the qualified business income deduction could drop that marginal rate as low as 29.6%, but that's subject to some limitations there. Now, where this gets really interesting then is thinking about, should you be keeping some of those after-tax proceeds in the business? Because as a C Corp, now you have 14% more cash that you could be reinvesting into your business. But if you're not reinvesting that cash, there could be some potential issues upon getting that cash out of the business.
Yeah, exactly, Don. I think it's never as simple as it looks like on the surface. Clearly, the C corporation, just in a pure current income tax situation, is going to have an advantage over our pass-through S corps and partnerships simply because there's a 21% rate at the C corp level, and even with the qualified business income deduction, they're at a 29.6% rate. So you could have an 8.6% swing there at the federal level, and if they're not eligible for the qualified business income deduction, it's a 16% swing. But there is always that issue of, how do I get the money out of the company once I've paid tax on it, and is there another level of tax or another tier of tax on it? And C corps are going to continue to have that issue as a disadvantage for them. Qualified dividend rules really didn't change for C corporations, so you could still have a 20% tax on a dividend coming out of the C corporation, whereas once again, distributions that don't exceed basis from S corporations and partnerships generally come out tax-free at the time of distributions. So at least to that extent, the pass-throughs are going to continue to have an advantage over C corporations. But like all good tax situations, it's once again never quite that simple either, because at some point along the way, our business owners are going to be thinking about exiting their businesses altogether.
You can't forget about that, and it's something that many business owners aren't necessarily actively thinking about, but who knows, a potential buyer could show up on the doorstep at any moment and make an offer that you quite simply can't turn down. So when you're thinking about those exit strategies, maybe some of those cash flow issues that we were talking about earlier really come into play. If you're able to reinvest some of that cash that you're saving at the C Corp rate and grow the business, you can enhance that value of the C corporation and get more value upon sale. Now, where that benefit could potentially be reduced a little bit is, of course, there's no outside basis step up for C corporations like you would get on allocated income on pass-throughs. So that benefit of the lower tax rate could be reduced by then having to pay more gain by having a lower basis. But any good tax planning strategy can be mitigated around those potential issues. So it's just a matter of getting a good model out there and throwing in some assumptions and potentially coming out with a pretty good plan either way.
It seems like every year when we do year-end tax planning, part of what we need to do is run a good projection, and this situation is going to be no different. On the surface, it feels like a simple question, but I think once you start thinking about taxing current operating income, how distributions are taxed, and how the entities are treated on an exit, whether by a taxable sale or otherwise, it gets a little bit more complicated. And it does feel like there's really no substitute for getting into the details and actually crunching some numbers.